Welcome to the Corporate Treasury 101 podcast. We are joined today by Craig Chapman. He is a senior manager at Actualize Consulting and an expert in treasury systems, transformations, and netting, which is what we continue to break down in this series of episodes. This one, by the way, is the second section of the full episode that we published last week. It is a smaller format in case you want to learn about netting step by step. In this episode, expect to learn how does netting and multilateral netting work technically speaking, what are the tangible benefits of it from a company perspective, what are the links with cash flows and cash flow forecasting, what is the required setup to properly execute netting, we especially talk about technology and the location of it, for instance, and much more. If you like the episode, please do not hesitate to rate us on your favorite podcast app. It helps us a lot, the podcast as well, and it allows Hussam and I to invite more and more amazing guests like Craig. In other news, we published an ebook. If you were dreaming of finding the ABCs of Treasury in a book, well, do not search anymore. We got you covered. Head to the link in the description to download it, and the best part, it is completely free. By the way, the ebook just got downloaded by more than 100 people, so you might not want to miss that. With all that being said, let's get on with the show.
So you mentioned multilateral netting, sorry. How exactly does multilateral netting work in the technicalities of it?
Okay, let me try and at a high level, I'll walk you through a netting cycle. So there's two components to a netting cycle. It's processing the actual cycle itself, so all the different invoices for the month. And there's a process of closing the netting cycle. So to process the netting cycle, the first thing you're going to do is open it up. So you're going to open the netting cycle, which means, okay, now I can input or import invoices. It's eligible to start receiving invoices. Then my next step would be to import or input the preliminary FX rates that are going to apply to the cycle. These can change too. You can have a rate as of the 5th, and then right before you close the cycle on the 30th, you could put in a refreshed rate. It's usually not the prevailing rate every day. It's usually a set date and a set rate, which usually goes back to the accounting rate that's being used. So your accounting books are going to match what you're doing for netting. Then the next step is to generate preliminary statements. So I've input all the invoices, I put FX rates in. Now I'm going to spit out, let's say I have 50 participants. I'm going to spit out 50 statements for them to look at and say, as of right now, this is what it looks like. You're going to owe this, or you're going to get paid this. And this is their chance to dispute any items that they don't feel are correct with the other participants. So these usually get generated out via email as of a certain date, and they have up to a certain date to resolve it or leave it as the final adjustment. So that's processing it all. And I'm just waiting for them to say, okay, or waiting for that date to expire. No more looking at it. Then there's a process of closing the cycle. So this is where you're going to put in your final FX rates. You're going to process your intercompany or external settlements. So the settlements, when I say settlements, I'm saying, what do I owe or what am I going to get paid? That's the settlement I'm referring to. So it's one transaction per cycle, per participant. Then I have to release the payments if they're external. So I'm going to send them to the bank if it's actually an external payment. And then I'm going to distribute final statements. This is the best and final. This is what happened. And then you close the cycle, waiting to the next month to open it back up. When this is set up properly, it's really 99% automated, and it's just a matter of managing it and putting in the right inputs, and then having somebody at corporate distribute the rates and send the payments out. But this becomes a very automated process and efficient.
Okay, quick question on my side, Craig. In one of our recent interview with Daniel from a big, fast consumer good company, we talked about payment terms and the importance of when you establish a partnership with either a supplier or a client to agree properly on when you need to get paid, right? In this netting cycle, when you open it, do the payment terms need to be exactly the same across all the group's entities, or are the payments due throughout the cycle, but the beneficiaries need to wait for the closing of the cycle? How does it work here? Because entities might have to wait, and then it's put in jeopardy their cash flows, right? How does it work?
Yeah, it's up to the company to decide what invoices that they're going to interface. So if you're payables based, the payer has the option to block any invoice they do not want to pay in that cycle.
Mm-hmm.
And because if they did, it could increase the disputes. But if you're receivables based, that's where they would be able to block any invoices that they're not ready to pay as well. So it's really a case by case basis. Most of the clients are interfacing with their ERP, so that they can send the parameters or the date that they want to grab, like a due date, for example. They can filter all those invoices they want to bring into the process based on that due date, and that's how they can control the terms, because that due date is going to be set up based on the terms that are agreeable for those two parties.
So then you can choose which invoice you include into the cycle or not, but then you don't have a netting process that takes into account everything, right? You just cherry pick which invoices need to be.
It's selected based on the due date, where the due date is taking into account the terms that have been established in when you set up the relationship between the vendor and the entity.
Super clear. And so typically, just for our information, how long, I mean, what's the length of a typical netting cycle then? Is it 10 days, 30 days, 3 months?
One calendar month, unless the organization's on like a 5-4-4, and then they adopt their accounting cycle. But if their accounting cycle is calendar, it's usually a month, and it closes up on the last business day of that month, and typically settles that same day as well. But you can be flexible with settling the next business day. But more than not, it's going to be at the end of the day, end of the month. Sorry.
What are the typical challenges prior to implementing a netting? Because I guess you're holding for us the specificity of the implementation that we can't wait for. But what are the challenges prior to that? So why would you want to implement the netting in the first place?
Yeah, sure, I can answer that. So most of the clients or companies that implement netting are large multinational companies with a very complex legal structure, with intercompany balances across many countries and currencies, and they're going to face several challenges prior to implementing a netting that they're trying to solve for. One could be around large payment volumes. So they have a high bank transaction fees, they have settlement risk, they have FX payment costs. So they want to address that, and the way to address that is to reduce the payment volumes. There could be, because we're dealing with, let's say, 50 countries, 80 countries, there could be an inefficient use of resources where there's a high manual effort to enter and release payments. There's a time-consuming GL posting process. Anytime that you introduce manual effort, it's going to be error-prone. So some of this reasoning to implement would be an efficiency play, just to get more efficiency out of the resources that you have. And then one of the final areas would be under the tax and legal compliance area. Intercompany invoices may not be settled within the payment terms, as we just were talking about. Yeah. And also for FX payment costs, just to reduce those. The netting process will reduce those greatly. So those are the three major areas.
Okay, that's super clear. And to come back to one of the things you mentioned earlier, settling physically and internally, can you walk us through what the difference is here and what company would rather go for?
Yeah, sure. And you don't have to pick one or the other. You do per participant, but you can have a hybrid across your whole program. So multilateral netting is going to sum and convert each entity's transactions, payments into a single local currency, and that's going to be the amount they have to pay or they have to receive from the netting center. So once they calculate that amount, there's two options to settling it. You can settle the monthly pay or to or to receive to amount, you can settle it internally if you have an existing in-house banking structure. So this will eliminate the need for an actual wire to go out of the participant's bank account in their base currency or out of the netting center's physical bank account and base currency. So if you have the option to settle internally, that's the ideal scenario, but that would require an in-house bank and a netting to work side by side.
Okay.
There are limitations to settling internally. Some countries, for example, Taiwan, Singapore, and China, they don't permit settlement on the in-house bank account. So in these cases, the payment must be made physically. And most TMS, treasury management systems, should support either of those methods. I see a combination. There's some companies that just choose to settle everything physically. But if you have that in-house bank power, it's definitely worth using. Again, you're reducing your physical payments.
Okay. But then, sorry, being a bit the devil's advocate here, or I'm not sure of my English expression, but then you create an intercompany loan, right? Because one entity will still owe money to another. You still have something to settle, no?
Yeah, so it's not necessarily an intercompany loan. It's an increase to my IHB balance or a decrease to my IHB balance. But
What
when
is that?
we say
IHB
interco
balance?
loan, it's more of an interco movement as opposed to a loan typically has terms and conditions. This is just an increase of 10 grand or a decrease of 10 grand to my balance, depending on the direction that it's going. So it's no different. It's no different from taking a loan, right? Like a ZBA or another movement such as that. It's just additional money that should factor into your overall balance, because if you're a positive, you're going to be receiving interest. If you're negative, you're going to be paying interest. So these amounts, the netting amounts at the end of the month, would factor into that interest settlement.
Okay, so you have on top of your netting cycle, you keep track of the balances. If you're settling internally, you keep track of the balances, negative or positive, between the entities, and you need to pay interest as well on top of that. But the payment of this interest would be taking form with the physical transaction, right? Or do you also include that into the netting?
That so once this monthly amount is calculated, it departs netting. Netting shuts down, and that movement or settlement just goes into the in-house bank as just another regular interco transaction.
Okay.
So it's either an obligation or a receipt that you'll receive against your in-house bank account, and that interest would be calculated by the in-house bank, and the in-house bank would pay withholding tax if it applies. It would either settle the interest physically, or it also has the option to settle it internally, or basically capitalize it, which would be adding it back or subtracting it from the balance further.
Okay, that's rather clear.
Craig, what's an in-house bank? I've never heard of an in-house bank before. What does it take to have an in-house bank?
Yeah, so it could be another topic for another day, but it's a method that companies use to make best use of their own money. So they'll set up an in-house bank, and an in-house bank is going to operate just like a regulatory bank, without the fees, without the interest. It's going to use the corporation's money as a whole, and you're going to have a position with the bank. So let's say you're entity A and you have $10 million excess. The bank is going to take that from you and use it for obligations that other participants need. So if you had 10 million euro, somebody needs 4, they're going to transfer that 4 to that entity. And then everyone, think of it, I like this analogy as a checkbook. I have an opening position, I have ins and outs all throughout the month, and then I have an ending position. That ending position is it's my position with the in-house bank. So if I'm long, I would get interest paid to me. If I was short, I would pay interest. So from the bank's perspective, they're just grabbing all the money, pooling it together, and transferring it out. You can get sophisticated models that might do things like payment on behalf of, receipt on behalf of. So a payment on behalf of, or POBO, that's where corporate is making all the payments on behalf of the subsidiary, so they don't have to get accounts in those various currencies. And then they're just being charged that amount against their balance that they owe to the bank. Hopefully that
So
makes it clear.
no, so it's not like you fulfill all of those transactions with a partner bank. You really just are. You're so big you could be a bank yourself.
Yeah, it's all your money, so you
Yeah,
don't have.
but between
What it
different
does,
entities.
yeah, there's a lot of benefits similar to netting, where I don't want subsidiary A going out to a bank and saying that they need 10 million of a certain currency, because they're going to have to pay a markup on that. Where I have 10 million euro, I can give them without having that external either loan or paying a fee for that.
So that's
It's making the best use of the capital that the organization has. Yeah.
Yeah, and so just to add a little bit of that, and again, Craig, correct me if I'm wrong, but the in-house bank would be basically having a group of such a size that when you properly centralize all the processes, all the cash, when you have a proper netting system in place and so on, you can have one entity or a few that are dedicated to act as the bank of the group, and will have the same functions, and will be able to lend money or borrow money to and from different entities within the group, whilst of course optimizing the interest payments here, because you do not pay an external party, which would be an external bank, but then the different entities of the group. Is that
Yeah,
correct?
think of the bank as the center, so they would control everything. You can have one bank, or you can have multiple banks. So if it's a large organization, sometimes you'll have a bank in the U.S. and they'll service all the U.S. accounts. You'll have a bank in Europe and they'll service all the Europe accounts. Asia, same thing. But you could get away with one bank, but the in-house bank is the one that holds all the chips. So they're paying out, they're receiving, and they're coordinating all those movements. It's similar to netting in a way, except that it usually involves a lot of external transfers as opposed to internal.
Okay.
And if you have the two together, that's where you leverage the power of the in-house bank, because now I can settle to the IHB and I don't send a single payment out unless I have one of those restricted entities or countries.
Very clear. I think, Guillaume, we need to do a dedicated episode on this indeed, because my concept of what a bank is being blown apart right now.
That's absolutely the plan. It's a fascinating topic, and yeah, definitely we'll dig into that.
Very good. So going back again to another term that you used, Craig, earlier, you said something about payables-based netting and receivables-based netting. What can you help us understand what those are?
Yeah. So these are just two approaches to upload invoices. You can either do it from the AP perspective, or you can do it from the AR perspective. When you're doing it from the payables, the payee, who's the receiver, is the one that is inputting or interfacing the invoices. So they control the settlement in the netting cycle. Most netting centers are run on a payables basis because it's a simple and effective way to reduce the cost of making external payments. And the payer usually has the option, like I was mentioning, to block any invoice that they do not want to pay in the current cycle, which can lead to increased disputes, but it's an allowable event. And receivables-based netting, this is where the payer is the one inputting or in interfacing the invoices, so they control what is set in the netting cycle. And it's based on sales receipts. So this is a little different approach, and in my experience, not too often does a company go down this path. They're usually going to go payables, because it's hard to control the receivables. Where payables, we know, we have it out there, we know the data on it, and it's a lot more. It's a better approach in my view.
But so, Craig, sorry, we challenge every single answer, but it's just to dig into it, because that's super interesting. the AP of an entity is the AR of another, right? What one entity needs to pay is what another needs to receive. And since we are within the same group, we are talking about the same thing here in the end. Because if I need to pay you, Craig, I have an account payable towards your account, and you have an account receivable towards me. But so if we are within the same group, whomever input this invoice, it will be the same at the end, no? Or what's the nuance that I'm not seizing here?
Yeah, I think the payable is a lot more reliable and predictable because the receivable, it's going to fluctuate based on when somebody decides to pay it. Where when you establish the payable side, you know the due date, you know it's sound, you know you can almost rely that it's going to happen. Where receivables is just not as predictable. It's not as easy to interface.
Okay,
I hear your argument. I don't have the strong answer for why
no,
they're
that makes sense. That makes sense. So, how is the AR, the account receivable, materialized exactly? Because indeed, an account payable is the invoice that I receive, and that I need to pay. But the AR would be the sales receipt, for instance, the one you mentioned before, and
Yeah,
that's much less
it could be a
reliable.
sales receipt. It could be
Okay.
monies that are outside of the internal process.
Mm-hmm. No, that makes sense. Okay, that's clear.
Whereas the
Thank
payable is just that. It's only the interco payments with a
you. Mm-hmm.
specific due date. So now I can filter on interco and I can filter on due date, and I know I have the right set of data to introduce.
That's clear. Thank you.
Yeah.
Yeah, another question we had is what are the key considerations when you set up a netting program? So you talked about all those different ones, right? The settlements, the bilateral, the multilateral. Why would the company do that? But so let's say I'm a massive company and I want to set up a netting program. What are the key considerations I should think of?
Yeah, so there's four primary ones, and what I'm talking about now is just when I'm establishing my program. It's not the mechanics of operating it, it's the precursor of getting a cycle in place. So the first one would be technology. Second would be choosing a netting center location. The third would be the tax impacts, as well as the regulatory issues. So from a technology standpoint, technology doesn't get it all done, but it's a key enabler for multilateral netting. I have to have a product that can perform all the functions that I need. I need the ability to generate preliminary statements, final statements in an automated way. I need the system to be able to support, payables or receivables. I need it to be accessible by the participants if necessary. So keep picking that piece of software, evaluating that piece of software specifically as it pertains to netting, and then ultimately selecting it is a key first step. Just making sure that you have the technology in place to actually do this. It's not something you would do in Excel, for example. And then the next thing, this is where you're going to have to get tax involved, but choosing the netting center location. So based on where you choose to locate your netting center, this could have potential tax drawbacks or benefits. So that the tax team needs to analyze it, make recommendations. Where I usually see the Treasury Center being located is in Luxembourg, Switzerland, the UK, Netherlands, Ireland. So essentially tax-friendly locales. It also depends on where you're located. That's a driver as well. But picking that spot is key. The tax impacts in certain countries could allow you or could make you pay withholding taxes as well. So you have to be aware of that. And then there's various regulatory issues at the local level that define what countries can participate in netting and what restrictions are on those participants. So some allow you to participate, but you have to provide reporting to the central bank, for example. Other countries, you can't participate at all. So that tax and legal review would go through each one of your participants or entities and determine who's in, who's out, and then how you structure your program. So those are the key ones. There's other considerations as you go to implement, but to start with, I would focus on those.
Okay. So most of them are crystal clear. On top of that, I'm not sure we want to dig into the tax and legal considerations of each location. But there'll be a small question on my side will be, you mentioned the technology aspect, which was actually the first one I think you mentioned. Is it something typically that you can do in a TMS or in your treasury management system, or are you looking at more specialized tools because of the complexity of it?
Yeah, a good point. So most TMSs can accommodate netting. So
Mm-hmm.
Kariba, Quantum, FIS Quantum,
Mm-hmm.
G Treasury actually recently just bought CoProcess, which was a strong netting product. So they're in the process of incorporating that into their TMS. And then for those that are implementing SAP, they also have a netting module within their offering. But a TMS, most of the popular TMSs will be able to handle the netting. That doesn't mean that you don't evaluate and run through your test cases, but you want to talk to references, make sure that they're actually working on it and doing it. So yeah, TMSs would be able to handle this, the right ones.
Yeah, super clear. Thank you.
So, Craig, you mentioned like a few different departments beyond Treasury. We had Mike Richards on our show a few weeks ago, who is a Treasury recruiter, and one of the lines that came out of that was that Treasury is a lot of interdepartment play. You really touch every single department in a company. So, with that in mind, you mentioned legal, you mentioned tax, you've also mentioned tech now. Who are all the different parties involved in setting up a netting process? Sounds like it's more than just Treasury themselves.
Yeah, it's great lead in for this because the accounting team has to be involved. So they're going to be responsible for monitoring, entering, and reconciling intercompany balances and payments. So they need input to the process. They won't actually be the ones executing the netting, but they'll be taking those transactions and having to reconcile the interco bals as well as the payments. Then a big part of this is getting corporate and international tax involved. They need to sign off on the netting structure, actually recommend the netting structure, and they'll be the ones that would research all the tax regulations, determine who can and cannot participate in the program. They'll also be reaching out to local teams because there could be some local regulations that are at a lower level than the country regulations. So they have to be a strong partner in this. You're also going to need the financial operations and ERP team. A small component of this is to integrate your invoices, normally from an ERP, into Kariba or into Quantum, either at an individual invoice level or an aggregated level. So there's an element of data exchange there that has to take place. Then we can't get away from having to drag in legal. So legal would be drafting up the netting agreements, setting the terms and conditions, and any other ongoing document requirements that are at the country or local level. And then finally, Treasury would be there for managing the netting cycle, executing the settlements, both internal and external, doing the FX management, the trade execution, monitoring and compliance, and they're a big factor into the technology selection along with any IT involvement. So it's essentially the whole company.
Basically, that's how it sounds. But that makes sense, right? Since it's account payables and account receivables, you need the sales and the accounting party. If you want a proper netting center, you need to consult the tax and legal department. So that makes sense.
Definitely.
All this sounds like a nightmare to forecast your cash because you don't really know what's going on until later on. Like it's a whole, because you net everything at the end. What's the implications of this in cash forecasting overall for a company? Again, a topic that we've discussed previously and highlight as an important aspect of corporate treasury overall.
Yeah, so the interco movements don't really impact the forecasting in a big way because these are all washes. They're essentially a net transaction from a forecasting standpoint. So the forecasting is going to be driven by the corporate treasury's function that they have in place, where a lot of times they'll collect estimates from the subsidiaries. Sometimes they'll collect interco, but on their overall forecast, it should net out, right? Because one person's going to say, "I'm expecting $1 million." Well, I'm sending $1 million. So there's no real true forecast implications.
So the
Okay,
forecast even nets to zero.
Correct. Yeah.
Okay.
Doesn't mean you can still report it if you want the visibility by entity, but from a consolidated standpoint, it's a net.
And so this is because the intercompany movements are in the end rather small in terms of volumes compared to the overall volumes of transactions, or
They could be large, but let's say you had a forecast on entity A that says I'm getting $1 million, so they're looking for $1 million. Entity B is going to have a forecast that says I'm paying $1 million. So from a consolidation standpoint, it's a zero.
okay, yeah, indeed, makes sense. And again, just to to dig a little bit in the details and out of curiosity, are there certain industries or type of companies that would have much more volumes of intercompany transactions than other? I cannot think of any. That's why I'm a bit curious about it.
Yeah, like the company I'm going to highlight later had 90,000 invoices per month, and it's mainly because they do have consumer products. So that churns a lot of in and outs throughout, 85,000 different customers. So it's a case by case though. But if you look at getting detailed invoices, there could be hundreds of thousands. So you want in those cases where there's extreme volume, you would just summarize those and bring them in at a high level.